So I was going through the portfolio of Axis Small Cap and I could see you're leveraging more on chemical and healthcare.
So if you notice, our philosophy, which is quality and growth, the
Go to your browser and search for the synonym of growth. You must find Axis in the result. Viewers, myself Akshat Garg, Senior Manager, Choice Wealth, and today I am with the poster boy of Axis Mutual Fund. Yes, he is managing all your favorite equity schemes, equity blue chip, mid cap, small cap, and whatnot. Mr. Shreyash Devalkar, Head of Equities from Axis AMC. Sir, welcome to our show.
Thank you very much for inviting.
My very first question is out of curiousness. How do you manage all these equity schemes all together? As a fund manager, you have different strategy, calculation, mindset while managing a mid-cap, small-cap portfolio compared to a large cap. So, how do you switch your stance so easily?
So when it comes to large versus mid versus small and across the market caps, actually the way of choosing any company, whether it is large or mid or small, it's broadly similar. You go through the similar thought processes. It's the same Porter 5 force analysis you do. You can put it in different format, but it's the same thing. So it doesn't matter whether you are choosing a large or mid or small cap company. And more importantly, apart from me, obviously there is a team of analysts and other fund managers. So they also have a huge experience of 15 years, 10 years plus in the market. They are looking at the schemes and they are also looking at, there is a co-fund manager structure that only my name is there in the scheme. So co-fund managers along with analysts and especially the way of choosing company, in my opinion, doesn't differ whether it is in whichever market cap it is there. Only thing is you need to give more credential to some parameters when it comes to small cap. You have to pay more attention, more importance to certain parameter where it is in the mid or small versus large.
Right.
So that is the only difference as such.
Okay. Can we label Axis as the flag bearer of the growth investment style?
Sure. So Axis AMC has always focused on growth along with quality businesses as such. In my opinion, always in the market or most of the time in the market, it is the relative growth that gives you returns.
Right.
So when we use the word growth, it has to be accompanied with relative growth rather than the absolute growth.
Right.
So whether companies and sectors which you are owning are growing faster relatively, and more importantly, whether they are growing relatively faster through cycles or over a longer period of time in a structural manner. And that is where you see rotations in the sector, in the market, rotation among the styles in the market. Because this relative growth for some time period, you can observe it in certain segments of the market as well as sectors. Well, at some other segment, you don't find it. So that's where we focus that whether your portfolios are into or if the companies which you are invested into, they are in the relative growth segments or not. And on the other hand, along with it, there should be good quality. By quality, what we mean is, obviously, companies should be working also in the interest of minority shareholder. Obviously, they need to take care of all the stakeholders.
Definitely.
But then they should be also working in the interest of minority shareholder. That is, in my opinion, first and foremost barometer of quality management. After that, most of the other parameters, which are, in my opinion, should get reflected in numbers, especially when it comes to return on equity, when it comes to return on capital employed, free cash flow generation. So all these things should get reflected in these numbers because whatever we analyze by way of whatever model you use, whether it is Porter's, whether it is business analysis, there are multiple models for that. But then with those models and application of those models, the net outcome should be that the companies are delivering in numbers.
Right. So I might not be wrong if I say growth is your forte.
Yes, so the relative growth along with quality is what I would call it as the fourth.
Right. Could the rising commodity prices play a spoil spot in the Indian equity markets for, let's say, next 1 and 2 years?
See, as far as commodity prices are concerned, there are multiple aspects to it. And most importantly, geopolitical aspects are playing out a lot in this rather than pure demand and supply. So it is, I would not use the word artificial, but the supply constraints created by geopolitical issues around, along with obviously the higher interest rate and all, it's affecting commodity.
Okay.
Now, when the commodity prices increases, it has impact on everything, raw materials as well as the inflation and then the interest rate, and it starts affecting everyone.
Right.
Interest rates, demand,
Everything.
the names of the banks. It also affects NBFCs. Then it also affects the margins of the companies. Now, when we invest, obviously this parameter one need to keep in mind. First, obviously, whenever such thing happen, first thing to look at is who are the beneficiaries of this. So the direct beneficiaries, obviously, maybe they may be in the commodity businesses, or they may be in the businesses, similar such businesses where there is supply constraint going on.
Okay.
And those businesses obviously are also of importance, and mostly you will find that such businesses are in B2B segment of the market, and that's where we focus on that segment. And mostly those companies you will find in mid and small cap, so we focus on those segments as well, and that's where you will find multiple such companies in our mid and small cap oriented funds.
Yes.
When it comes to the negative impacts of rising commodity prices, the negative impact of rising commodity prices definitely get reflected in the businesses where the raw material prices go up. But one need to again there focus then who is having the pricing power. Again, that pricing power depend on the segment you are working. So, for example, the K-shape recovery, which we have noticed. Now, if you notice the upper part of K, the beneficiaries of K-shape recovery, and you look at the consumption items there, you will notice that rising, just not because of commodity prices, but in rising inflation definitely has led to an associated demand supply as well situation. The hotel rates has gone up, right? Again, it is catering to the upper part of K. SUV prices, or the prices of the car which are upwards of 10-12 lakh rupees. There you have car, SUVs, and there you are seeing the inflation there. It is getting passed on, and market is absorbing it. But probably at a lower end of, now if you look at a lower end of K, where you take FMCG, whether their premiumization is getting noticed, may not be as such the way you want to see. So one need to be selective when you look at the adverse impact of this commodity and how it is affecting various segments of investment. And accordingly, if the segments are more catering to the upper part of K in the K-shape recovery, then probably the ability to pass on these commodity prices is high. While in those segments which are catering to the lower part of K, there the ability is relatively less. So you need to differentiate among them and trade accordingly.
Okay, so in your portfolios, which stocks are of major component, the upper part or the lower one?
So lower one are also there, but the higher proportion would be definitely the upper part. So if you look at our large cap portfolio, then maybe autos may be much higher than FMCG.
Right.
And then again, if you look at retail credit growth driven companies, wherein and NBFCs, wherein again the consumption item of this segment is, though obviously they are borrowing for a reason, but then end of the day, these bank and NBFCs are also lending to that class wherever there is ability to repay. And again, the good part of Indian retail segment has been that multiple crises it has gone through, including the latest COVID.
Yes.
And the asset quality end of the day has been better or much superior than what market would have expected. So the behavior of Indian retail has been really great across the crisis. And so the crisis can be by way of rising commodity prices,
Yes.
It can be by way of COVID, it can be of whatever. But then point is that whether the segment which you are catering to, whether that segment is lucrative or not.
Yeah, I also feel that there's a dramatic change in the spending patterns and consumption patterns post-COVID, right? In the retail behavior. If we see, in the last 2 years, Axis funds have underperformed its peers. So what are the reasons for it, and what are you doing to get it back on the track?
So if you notice our philosophy, which is quality and growth, the general you will notice that in last decade the market has rewarded this, and there is a reason. And I use the word, when I use the word growth, it is about relative growth. It is not about absolute growth.
Right.
So the relative growth in the last decade was definitely in the quality and growth companies, which were more oriented towards the consumption part of economy. And for various reasons, we can get into the detail of why not investment, why not exports, but there were multiple reasons, and it was definitely in the consumption part of economy. When post-COVID, because of multiple reasons, the consumption part of economies and the related companies, their growth also was actually, compared to the crisis through which we have gone through, definitely they are doing good.
Right.
To the extent of crisis, COVID crisis which we have gone through. But their relative growth got affected also because of slowdown in them relatively. So earlier, if they would have grown at say 15, 20, 25, 30, now they are growing at sub 15. So there is that angle which has played out. On the other hand, the relative growth also got reflected more into the exports and investment part of economy, because again various reasons, right from government spend to, because of geopolitical reason, multiple exports opportunity got opened up.
Right.
So the export and this part of the opportunities got rewarded more in the post COVID market scenario. So this when we say growth,
yes,
so the growth can be good in 1 year, it can be good in 2 year, 3 year, 5 year. But what we tend to look at is what is the structural growth and what is relatively short cycle growth. Now, the short cycle growth, maybe again, it's the verdict is to be out. But then in some of the commodities, we have seen the short cycle growth.
Right.
That it just went up and then it plateaued and came down. And because most of it was also associated with COVID, then geopolitics, etc. And some of those parameters reversed and the growth reversed. So when it comes to the structural quality and growth as a philosophy, then such sectors we generally tend to stay away from.
Right.
While the sectors where there is relatively long cyclical growth, there we have also entered. So probably your next point would be that what we are doing to do this. So you will notice that what I highlighted, that the beneficiaries or the real bottom-up beneficiaries of investment part and export part of economy has been in mid and small cap. So our large cap oriented funds generally has not been more in the mid and small. So we have increased exposure again over last 2-3 years. It is not that now, but it's over last 2-3 years in multiple funds. So our mid and small cap, because naturally, because that universe provided that opportunity. So our mid and small cap universe, you will notice more of those segments.
Okay.
While large cap oriented funds, we have some, but probably not to the extent what market warranted.
Right.
So in this scenario, there are two things to observe. One is whether this trend is on for how long and where it ends, and then even now whether one should change a lot. In my opinion, two parameters which are watching out.
Okay.
One is the relative valuations. So if you notice before COVID, that market, the relative valuation of these companies which are export and investment oriented companies that was at substantial discount to the consumption-oriented companies.
Right.
And with this sharp rally in last 2-3 years, that gap has breached substantially. And if you adjust for the ability to generate free cash flow as well as ability to generate return on capital employed, then in my judgment, that has broadly got breached already.
Okay.
So that is the one comfort which we have to stick with where we are. Second is, as I said, on the relative growth front, the investment and export part of economy have done definitely better than the consumption part. In my judgment, again, the export part of economy or the companies which are oriented toward the export part of the economy, they have started slowing down.
Right.
So you must have observed first IT slowed down. Then the numbers of some of the commodity-oriented chemicals came down. Now even some of the capex-oriented or capex export-oriented companies, capital goods-oriented companies which are also exporting, they are also highlighting that in last couple of quarters that their growth also, when it comes to export, they are seeing some trouble. So now, when it comes to relative growth, yes, the export part is seeing some trouble because of the global issues. Investment piece continues to do well. So in such a scenario, yes, the relative growth again, which got shifted, probably barring investment piece, where still there are good tailwinds even now. So we are adding some of that. Already we have added some in the investment part. While in my opinion, because of the relative risk reward, even the consumption part is attractive. Whether there is a delivery on ground and turnaround, the answer is no. But then on a risk reward basis, it looks okay now.
Okay. So my next question is from my viewers. What's driving the sustained rallies in the mid cap and small cap portfolios, and will the party likely to continue?
So again, when it comes to mid and small cap, my observation one of that, which I have been sharing, that mostly the consumption-oriented companies are in the large cap. So if you take retail credit growth-driven successful bank and NBFCs, you take FMCGs, you take auto OEM, broadly this part would comprise closer to, in my judgment, 60% of the large cap indices.
Right.
And that's where this part, having not done good on a relative growth front, even the large cap indices suffered. So actually, if you notice, October 21, when market first peaked, from then till now, now it's almost 2 years.
Almost 2 years.
And Nifty would have gone up by hardly 3 to 4% CAGR in 2 years. Now, because of this particular reason, now if you go to, and then there are some company-specific issues as well, that is a different story altogether. But when it comes to mid and small cap universe, there the representation of investment and export part of economy has been higher. So you take chemical, you take auto ancillaries. Auto ancillaries has that export component, most of them. Then you have capital goods, multiple small companies are there in the capital goods segment, power segment. So multiple such segments you have found that there is a good exposure in mid and small cap universe to such. And that's where you have seen the rally shifting apparently. But it is more than mid, small versus large. It is, to me, it is more to do with the consumption versus the other part of economics. So because of this rally, definitely the valuation differential, what I talked about, maybe some of this investment and export part of economy oriented stocks in the pre-COVID era would have been right from 8-10p to 15-20p. But now in this rally, they are now right from 20p to 40, 50, 60p.
Crazy numbers.
So this shift has happened.
Right.
And that's where, though the growth is maybe continuing out of the three part of economy in investment more so. Partly it is priced in, partly it is not. But then one need to be careful now on the export part of economy and associated stock in the mid, whether they're in mid, small or large, doesn't matter. One need to look at which segment the stocks are, or the companies are operating, and what those segments are doing.
Right. So are you hinting towards sector rotation that you're not looking at it across, like you're not thinking it's a large cap, mid cap, or small cap, but you're thinking as a segment wise that which segment is doing well.
Yes, that is most important, because your economy is about GDP, is about investment, export, and consumption, and these shifts would affect. And again, most of my commentary is more based on the listed universe, because
Right.
when you go and try to exactly compare with GDP, then the listed universe don't exactly map the GDP construct as such.
Okay. What's your style of investing? Like, do you prefer macro investing more or are you a bottom up guy?
See, both of them are interlinked in a sense that when in the bottom of what you do is you identify whether that company is good or not.
Right.
And again, I would go back to the famous Porter factor, because everyone would have
Right.
learned and
That's what you like.
because there are multiple complicated models of that.
Right.
But then that is the basic model which every one of us has done. So when you look at any company from that perspective, then obviously it is a bottom up stock picking, and which we tend to do. And that has to be done for every stock. But at the same time, the way I told you that there may be many good consumption oriented companies, but then if the segment is not seeing growth, if the lower part of K or rural, multiple such things, then even if the company is good, obviously there may be limitations to the growth, what one can look at it. So that's where even that top down matters in a
Right.
sense. So nothing is in isolation, but more weightage to bottom up, more because that when it comes to cycles,
Okay.
you may or may not be predicted and trade through it at the right time.
Right.
So if you are invested in the good companies at that, even if you are on predicting the cycle right, at least the company can help you. So if the growth is slowing down, but the company is good, then the company is gaining market share, at least the drawdowns you will not see more in the companies. While on the other hand, even if you miss the upcycle, but if you have that good company, that will definitely benefit during that. So in that sense, in a portfolio, this bottom up matters, and bottom up stock picking, it's the weightages which you end up giving.
Right.
Obviously then would more depend on the top down part of it. And that's where again it's again bottom
please.
versus top down is interlinked again.
Yeah.
So why the company is growing, obviously because the environment is helping and the company is good. So both of them go hand in hand.
So I was going through the portfolio of Axis Small Cap and I could see you're leveraging more on chemical and healthcare. So is it more like a tactical call?
So if you look at Axis Small Cap, there are multiple segments. So you're right in pointing out healthcare, which is predominantly hospitals. Then there is chemical, there is auto ancillary, there is some financial. So and there is IT as well. So there are multiple segments out there. Coming to particularly these two segments, definitely we have seen that when it comes to healthcare segment, there has been increase in the revenue per bed for most of the hospitals. This industry has shown some pricing power. Again, it's more than pricing power. It is ability to pass on the prices with the rising services sector inflation. So if you look at in economy, when we look at inflation, we generally tend to focus more on the food, etc. But there is services sector, services inflation is relatively higher. This industry has been struggling through that inflation earlier. Earlier also this inflation was high. It was not that earlier it was low. But then somehow post-COVID, the industry was able to pass on. On the other hand, the beds availability, that also has worked in the favor because of maybe earlier underinvestment in certain pocket. It happened. See, it happened in multiple sector. It happened in hotel also pre-COVID era. For some point in time, there was not much investment in some of this. So wherever the pricing power has come back, those which even hotels also industry is benefiting because of that. So these multiple segments are helping healthcare as an industry. Okay. And again, the insurance is one more angle. The increasing adoption of insurance is also.
Yes.
When it comes to, and that's where we have had it so far. When it comes to the chemical sector,
Okay.
chemicals again we have added it over last multiple years. So it is not the recent phenomena for
Okay.
us. Actually, for us, the chemical rally started way back in 2016, or actually it started somewhere in 14-15. At that time, chemical stocks used to be at 8p.
Yes.
Probably till pre-COVID, they got related to 15 to 20p. And
Yeah.
post-COVID, from 20, they went up to 30-35p. So actually, that rally is not now for us. It has been for a longer time, and we have been getting into it because again, in the universe at that time at lower price to earning, most of these companies were small cap.
Okay.
And that's where our small cap always had this company through and through.
Okay.
And probably in the post-COVID, some of newer opportunities came that we even got in more. So as such, this industry has been doing well for multiple years. Currently, in last 1 year, it may be going through again a rough patch that must already has got reflected in the results of this industry. But this industry, in my opinion, considering the talent in India, which is in this sector, compared to probably IT sector has a talent.
Yeah.
While even in my opinion, chemical sector, India actually shines when it comes to the talent availability. And then promoters are ready to deploy money, capital market is ready to give money for capex. So all these things are also helping for the growth. Along and added to it is the China Plus One, where multiple supply chains are considering India to get included in their supply chain. So all these things are helping, but to me this has been a longer term process. Maybe the stocks got into limelight more post COVID because of some one-offs as well, like that because of supply constraints, some commodity prices just shot up, and then there was probably the illusion of this is the new trend, but then it was more pricing led. It is cooling off, so there was inventory stocking, probably inventory destocking is happening. So I think despite all these ups and downs, the industry has done great since over longer period of time.
Okay. Before I end, my just last quick question. We are moving towards 5 trillion. One sector you would bet on?
See, that 5 trillion every sector, and that's where all the three segments are important. And that is one of the reasons why you have seen the broad-based rally in India, because earlier maybe only one segment was doing well. Now everything is
Yes.
well. And that's where if one need to have representation of all three. If it means representation of all three segments, but so be it. But then one need to have representation of all three. And only one need to keep looking out for is the disruption in any sector. So normally what happens is when lot of capital with high return, lot of capital start chasing, and everyone start investing, the more disruptors start coming in, and that disruption can be just because of lot of money flowing in, it can be because of technology, it can be because of anything,
any reason,
or it is mostly the combination of both. That is where one need to be careful about. Otherwise, in my opinion, all the three segments one need to be watch out for. In near term, again, because of the global issues, maybe exports part is going through rough patch. Probably the valuations which got elevated a lot in last 1 year, 1.5 years, maybe there can be some, and already we have seen some correction in those that. So even from that point of view, even that segment also one need to be always on the top of, because this China Plus One, etc. will definitely help that segment as well.
Okay. Mr. Devalkar, I'm sure my viewers would love this power-packed session with such deep insights. Sure. Thank you for your perspectives. Thank you, viewers, for tuning in.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.